Welcome to the Innovation Ecosystem Podcast. We interview remarkable and thought-provoking guests about innovation, leadership, and change in the world of business. Whether you're an executive or an entrepreneur, our objective is to help you and your organisation create an entrepreneurial culture, become more innovative, and better able to respond to change. Each week, we'll deconstruct world-class performance from the arenas of business, academia, science, and sports. Each week, you can expect key insights, fresh perspectives, and proven tools you can use straight away to make you more successful professionally and personally. With your hosts, Mark Bidwell and Roddy Miller.
Hello, I'm Roddy Miller, your co-host on the Innovation Ecosystem Podcast. I hope you enjoyed last week's show where Mark interviewed David Allen, the personal productivity guru, where they discussed stress-free productivity and many other topics that you can apply straight away. Really worth a listen. This week, I'm talking with Colin Melvin. Colin is Head of Stewardship at the investment management firm Hermes, based in London. This is a new role he's carved out of his ongoing work with building a business that harnesses the power of institutional investment funds to influence the companies they hold stakes in for better outcomes, whether that be governance, environmental, or social improvements. In this show, you'll hear how Colin has influenced some of the most important and impactful businesses and institutions on the planet to change their approaches to how they operate and what tactics and abilities he draws on to achieve that. These are inherent skills we can all learn to use. Colin describes how his journey to creating this massive industry-wide change has unfolded, and I was particularly struck how he, like so many of our guests, has created the change evolutionally, making the most of opportunities as they arise. Listen out for Colin expressing his awareness of this through his description of changes that want to emerge, a key understanding for leaders to find leverage points to accelerate their mission. This has relevance for us all.
I'm really pleased to have Colin Melvin as my guest today. Like many of our guests on these shows, Colin has led change and created something new. The difference with Colin's story is that his career for the last 2 decades has not been so much about changing a business, but changing an industry. And this is not any industry. This is one that affects huge corporations in every sector across the globe. Colin is chairman of the equity ownership service side of London-based Hermes Investment Management and the head of its newly designated stewardship project. We'll discover what all this means shortly, but first, some figures. In this role, he guides some of the management decisions for $250 billion worth of corporate investments. And if that is not a gargantuan enough figure to play with, Colin was the founding chairman of the United Nations Principles for Responsible Investment, an accord that now represents around $50 trillion of investment assets. Colin, it's great to have you with us.
It's a pleasure to be here with you. Thank you.
Let's just take a few moments first to understand the role you and your organization play in the financial world. You don't actually make investment decisions, but rather engage by these investment businesses to advise them on how they can collectively work together to influence the operations and activities of the businesses they invest in. Is that correct?
That's right, yes. So our decision is to engage with the company on behalf of this group of pension funds. Our clients at Hermes EOS are 45 pension funds, and we engaged on their behalf in a collaborative way. So it's a bit like a coalition or a collaboration whereby the pension funds aggregate their shareholding in companies through us, and we then apply a resource which is greater than any one fund could afford, yet benefits them all. So the program is one of stewardship, and that is stewardship of the company that's owned by the pension fund on behalf of the pension fund to promote good behavior by the company, which should lead to better returns in the longer run.
We'll come to those sort of behaviors just in a moment, but these firms are clearly extremely powerful, carrying the voting rights for billions of dollars of shares in different stock markets around the world. Why can't they or don't they want to make these decisions themselves?
Well, they make the decisions collectively for a couple of reasons. One, they recognize that by working together, they can do more. So even a very large pension fund tends to have a fraction of 1% of the shares of a very large company. But if they work together, they can aggregate that through us into a larger proportion, maybe 1%, 2 or 3, depending on the size of the company. So that gives them more opportunity for change. The other, though, is there's a tradition within the investment industry of spending money more on transactions, on the buying and selling of things, than on relationships. And then that needs to change. And you could see the service that we're providing as part of that change. And it's a shift in focus from the short term to the long term as well. So instead of focusing on short-term transactional behavior, it's more to do with the relationship with the company as shareholder, but also the relationship that the company has itself with its stakeholders, and then how improving those relationships can lead to an improvement in the outcome for the investor, as well as the economy, society, and the environment, all at the same time.
So the drive for that, though, is coming, you think, from outside, externally, from the wider world, or is there something intrinsic within the pension funds that they want to do this?
I see this as a societal shift. We around about the time of the financial crisis, regulators in the UK and around the world realized that the banks that were failing and bringing down economies, or potentially so, had owners and shareholders. And who were those shareholder owners? Well, they were us, through our pension funds and our savings. And there seemed to be a disconnect then between the interests of the underlying owner, the pension fund beneficiary, and the company that was owned, the bank, and the other companies that were owned and connected to that bank. And that shift in understanding has been playing through since 2007, 8, 9, and has led to new regulations which have encouraged pension funds to be better owners of companies. And I think there's, alongside that, a growing understanding in the public at large that we can't continue to run the capitalist system the way we've been running it. It leads to really very poor outcomes, where large companies that we all invest in through our pension funds are involved in bribery and corruption, involved in environmental degradation, child labor, or modern slavery in some cases, avoiding paying tax. And all of these things, to some extent, in our name and presumed to be of benefit to us because they maximize the short-term value of the shareholding. And that's just a very poor outcome because, of course, pension funds invest for the long term. And with a pension fund with 20 to 30-year liabilities, shouldn't be concerned about the short-term performance of the companies they invest in. So that disconnect, I think there's a shift in understanding. I kind of, what I would have called in my early career as a historian, a hegemonic shift, a shift in the language and the ways in which we understand our jobs in the investment sector, which is leading to a more of an engagement with the companies, less of a transactional focus. And that's the reason we have the service. And we set it up 11 years ago here, but it's really growing quickly now. And we're getting a lot of big pension funds coming to us, asking us for help.
It's interesting. There seem to be two sort of pivots there. One, the short-term, long-term balance that you're trying to shift them towards, and also this change, societal change that you recognised between transactional and relational interactions. And I never really thought about it before, but it clearly there's a big connection between those two things. I mean, relationships ought to be longer term, and transactions are sort of instantaneous. They're one-off. So there is a connection there, isn't there?
Yes, I think so. And most of the dysfunctionality within the investment system arises from short-termism of one kind or another linked to transactions. And at its extreme, of course, you've probably heard of dark pools and high-frequency trading and so on, which really doesn't have any social utility. But it still happens, and it often happens with money that you and I and many others in the economy and society have invested. So it seems that we've created a transacting machine in the city and in Wall Street, which transacts at a frequency which it can determine, and which transactions it benefits from, because it's paid fundamentally for transactions. Where the proper functioning of the financial system and the investment markets should be the allocation of capital efficiently and effectively within the capitalist system, within our economy, to sustain and enable the development and growth of the companies that we save through and work within. So there's a problem there, and as I said, we then need to shift our focus from that short-term transactional behavior to longer-term relationships, and it's not that there shouldn't be any transactions. Of course, we still need to transact, but it's a question of what's important and what we focus on. And if we can encourage the large companies that we all invest in through our pension funds to have better relationships with their employees and their suppliers and their customers, and indeed their shareholders and other stakeholders, those improving relationships lead to an improvement in the value of the firm over time. And that's, I think, a much better understanding of how value is generated within the economy.
But do the pension funds, or are the pension funds in a position to instruct their asset managers, their investment managers, to transact less? I mean, does the governance of a pension fund cover that? Because it seems to me that the transaction side is very much driven by the city, the trader approach.
It's really a bit of a situation of supplier control. So the clients of the city, by and large, take the terms offered to them. There's a lot of tradition here, and just assumption that this is the right way to behave. And as I say, I think people are understanding that needs to shift. But the tradition is that money's managed on a short-term basis. So even if the pension fund gives a mandate of a year or so to the fund manager, often the fund manager is concerned about that contract being terminated at short notice relative to short-term poor investment performance. And that performance is measured quarterly. And as you're aware, many companies provide quarterly reports to sustain this approach. And so you have this, again, short-term approach within the relationship between the investor and the company, which is, I think, detrimental to corporate success. If you're the chief executive or finance director of a medium to large company in the UK, for example, your experience of talking to your owners, the shareholders, is really not very good. You find you're talking to people who are far more interested in getting information about next quarter's earnings than they are about the people in the business or the longer-term strategy and so on. And that's such a huge missed opportunity because, of course, our fund managers are often very knowledgeable, well-educated people, and many of them could do a job which is far more interesting and useful than they're presently able to do. And in some ways, it's a return to the way investment used to be, which was far more relational than it is presently.
No, I see that completely. Is that? I mean, that's clearly a part. I mean, that's all tied in with this ESG investing on the environmental, social, and particularly here on the governance side, which is underlines the principles for responsible investing at the United Nations that you were a co-author in putting together. When was that? 10, 11 years ago.
10 years ago, yeah. It's the 10th anniversary. It was just a couple of weeks ago.
Oh, is that right? Okay. Yeah. Congratulations. And that is focusing on more active ownership with this wider societal sense to it. But again, the drive from that came from where? I mean, was it from within the finance industry, or are you having to change, or UNPRI and yourselves having to re-educate, change the pension funds themselves from the status quo that they're currently in?
There was a small group of about 25 funds involved in the initial phase of this. So going back to 2004 or 5 when we drafted the principles. And they were based on a set of principles of the United Nations which focus on companies. So the UN Global Compact is a set of 10 principles for companies around their behavior, and it links to the treatment of the workforce, and environment, human rights more broadly, and so on. And the UN Global Compact was very successful. It now has 8,000 companies signed up to it, and most of the world's largest companies have committed to these principles. So it's a very significant initiative. And so what we wanted to do was to bring something in similar for the investment world. And so if we could find some principles for responsible investment, which is what they're called, then that might benefit investment and the economy and society more broadly. And there are 6 principles of the PRI. The first 2 are the most significant, I think. The first one, we'll incorporate what's now known as ESG, as you said, environmental, social, governance factors into our investment decision-making, really meaning a more qualitative rather than purely quantitative analysis. And the second is that we'll be good owners of the assets that we invest in, on the understanding that good ownership, or stewardship as it's now known, will lead to a better outcome. So that you're engaging with companies at a very senior level to get a change where change is needed to improve their performance over time.
I mean, I'm really interested in that change. I mean, what you're doing is trying to create change sort of through these principles. But in just getting the principles in place in the first place required a great deal of change. And I think what's fascinating about this story is that you're operating at really a huge global level. You're trying to create industrial ecosystem-wide change. And the United Nations provides a platform for that, but you're therefore dealing with heads of very large organizations, country level diplomats. When you started, from you personally, were you aware of what it would take to have these conversations and persuade people?
But it's sort of a compulsion for me, I think. I tend to find myself, or have done in my career, in positions where I'm getting people to work together, resolving conflict or finding ways in which we can do better by bringing different people from different perspectives. My involvement in this area goes back some 22 years. I was at Standard Life Investments in Edinburgh early on in my career, and trained as a fund manager and qualified as a fund manager, but very, very early on realized that there was something more interesting happening, which was that this new field at that time of corporate governance grew up, which described the relationship between companies and shareholders. And that just seemed to me way more interesting than the short-run financial analysis that my colleagues were involved with. And it was that understanding, that the opportunity to bring shareholders and companies together, which I took into the UN project. And so the most interesting principle for me is that second one, that link between the shareholder and the company, as well as the longer-term perspective that's required. In terms of the funds themselves involved, the changes that you want to be part of, or are best to be part of it, are changes that want to emerge. This is not something that I created myself, but rather tuned into. And I gained an awareness that there was a group of leaders within the investment industry who wanted to see a change. And I should say this change has not yet happened. Though it's 10 years anniversary has just come and gone. The PRI represents a huge potential for change, which is still, I think, largely unrealized. So it requires more effort and more momentum and impetus. But at that time, there were a group of leaders, heads of fund management companies and pension funds, and particularly the pension funds, with an understanding that the money of the fund wasn't being managed consistently in the interests of the beneficiaries, the people who were saving through the pension fund, and that needed to change. And we described those changes in 2004-05, launched the principles in 2006, and then we had a financial crisis a year later. And at that point, I thought, well, we're going to lose this. It's people will retreat to short-term money,
sure,
which is what you would expect in a financial crisis, and the project will be lost. And so, very happily, with the support of the BT pension scheme, which owns Hermes and Hermes Investment Management, we went on a bit of a media tour and explained that the companies that had failed, the banks that had failed, had owners, and they were the pension funds and the pension fund beneficiaries, and we needed better stewardship, so this sort of thing was less likely to happen in the future. And the UK government picked up the language we were using. We got the stewardship code here in the UK, which has been copied now in several markets around the world, including recently in Japan, Malaysia, and elsewhere. And we found that we managed to regenerate some momentum, and indeed it's continued to this day. So a lot of interest at the moment, but
so that bit there, where it's about regenerating that momentum, I think is fascinating. So you say that the UK government was supportive about generating this stewardship code.
Yeah.
What happened from there that the other countries picked up? Was it spontaneous from their side, or was there?
It manifests in different places in different ways. So the most recent one, take as an example, in Japan. So the Japanese economy stagnated over many years, decades, as you will know, and Prime Minister Abe, in his Abenomics program in Japan, has decided that if he can get the shareholders of Japanese companies more interested and involved in what companies are doing, that should be a benefit to the Japanese economy. And in particular, there's a lot of cash on balance sheets. There's a poor level of diversity at board level and so on. And if something could be done about that, then that would be to the benefit of the economy, as I said. And the Japanese shareholders, Japanese shareholders in Japanese companies tend to be quite passive by tradition. So this new stewardship code was introduced last year,
but by
the Japanese government and the regulator. So I think it's formally attached to the stock exchange, and about 170 funds and fund managers signed up on its launch. And they're now still yet to implement this fully, but the government pension fund in Japan has done some amazing things already. They've recruited people. This is the biggest pension fund in the world with $1.3 trillion. And the Japanese pension fund has made it very clear to their fund managers they expect them to be good owners of companies on their behalf. And they even most recently wrote to the larger companies in Japan and asked them what they thought of the fund managers, as to whether they were doing a good job in interacting with them as companies, which was a really brave thing to do, I think. So there's
what's the response to that? Do we know?
We don't know yet. That was just in the last few weeks. I saw the report, which, I mean, they came to the unsurprising conclusion that they could be better owners than they are being, and that the fund managers need to do more. But it's a great example of a direct link by government and regulator in Japan being made between the quality of ownership of companies within their economy and the quality of the companies themselves and the extent to which they're then able to contribute to the economy. And there are big things to fix in Japan. Only 3% of board directors in Japan are women. It's the lowest of any developed economy. And there you see a huge potential as well. And they're trying to do this. The Ministry of Economy Trade Ministry in Japan is got a program trying to get more women into the workplace because, of course, that's a huge untapped potential for the economy.
I mean, I had a question which was, around the fact that you've put the principles in place, or been part of putting the principles in place. You've established this part of Hermes, which does the stewardship and the services, the advises the investment firms. So that's a nice piece of creation and creating the structure. And my question was going to have been, is just running it out now going to be rather less exciting? But it sounds to me, from what you're saying, is that the hard work is still yet to be done.
I think so. Well, I don't run Hermes EOS day to day anymore. I'm chair now, and I have a new role, which is to look at the dysfunctionality of the system. So the kind of things we're talking about. So Hermes EOS, I founded 11 years ago to address effectively a market failure, which is that the intermediaries, the fund managers who sit between the pension funds and the companies that they own, those fund managers by and large don't do much engagement. They don't behave as good owners of the companies. They simply transact. That's the market failure. And so we created Hermes EOS to address that by providing a group of pension funds with a service which would represent them in discussion with the companies that they own. But what about the failure itself? That is a much more important issue, because if we could properly recognize the interdependence of shareholders and companies, and the interconnectedness, and maximize the value of the relationships the companies have with their stakeholders, then that's hugely to our benefit, because that increases the total sum of wealth. It's very different from a transactional worldview, which sees a kind of zero-sum game. There's a finite amount of wealth, and we're just simply trying to get as much of it as possible for ourselves, and which is a very poor way of looking at investment. So that's the shift, and so my new job within Hermes is to address that market failure, to work with other fund management companies, even our competitors, with our clients, with academics and opinion formers, to try to come up with a new way of looking at the investment world, which is less transactional and more relational, recognizes that interdependence and interconnectedness, because increasingly in the conversations I'm having with leaders of fund management companies and pension funds, I'm finding people leading these firms who know that the way they're investing is wrong in some respects. That they know what the right thing is to do, but they find that they can't do that. They're kind of forced to behave the way they're forced to at the moment because of the way in which the jobs are understood. So, for example, we all know that we need a carbon tax, a carbon price of some kind, probably internationally agreed or at least enforced locally. And that then, if it came in, that sort of regulation would lead to a reduction in the carbon exposure of our pension funds, which in the long run would be very much the right way to invest as regulation increases and so on. But we just kind of accept the situation and we're not doing anything about it. We're investing in a way which is contrary to the interests of the society and the environment and the economy in the longer run, but we're kind of forced to do that. But what if these big shareholders, pension funds and fund management companies got together and lobbied on the regulation itself? We could change the policy environment to make our success certain, if you like, in investing in the right way. And that's the kind of thing that I'm working on at the moment.
I mean, what sort of triggers do you think are required to make that happen? I mean, is it just a continual round of conversations and persuasion that over time people will change their mindsets, or are there more strategic things that you can do?
Well, that's what I did in relation to stewardship, and admittedly it took 11 years to get where we are, and maybe we need to move a bit more quickly. But I'm finding that this is a change that seems to want to emerge, to put it that way. And when I'm talking to the leaders of some very large fund management companies now, they are sensing that they need to behave in a different way. And so they understand the need for change, but they don't have the language or tools necessary to implement. And that's perhaps what I can provide. So it is a series of conversations with the largest funds and fund managers, and to get them to understand that they can change the policy environment, and that's to their benefit and to the benefit of their customers. It's a bit like there's a concept which grew up around the development of responsible investment called the universal owner hypothesis, which sounds kind of grand. And what that means is that if you're a very large pension fund, you invest usually in every company, every listed company in a particular market. So if you're a very big pension fund investing in the UK, you're likely to have a shareholding in most of the companies in the all-share index, so 800 or so companies. And that would be true for most markets. Most big pension funds invest in thousands of companies. Yeah. So they have, in a real sense, a stake in the entire economy. You know, if you invest in every company listed in an economy, then you have a stake in the economy itself. And it's entirely rational then that you should be interested not just in how those companies interact, but also how the economy itself is functioning. And you have a legitimate reason then to be involved in the development of policy around that economy. But investors don't behave that way. They behave as if they're investing in single companies, and they don't think about how those companies interact. So one company might be polluting, and that pollution might be going into a river, and the other company might be a farming company down the river. And you're happy with the company polluting if you're a cynical investor, because that company is externalizing costs, which is not then picking up. But of course, you pick up the costs elsewhere in the portfolio, and that's true of carbon emissions and climate change. So we need to do something about these things, and I would suggest that, and this is what I'm pursuing in conversation with the leaders of these firms, is that large investors have a legitimate interest in getting involved in a policy debate around the system itself, the economy itself, and the way in which they invest. And if they can change that so they can invest the way they kind of know they need to, then that's to the benefit of the economy and society and the environment. And then why wouldn't you do that?
Is there a role for government here. I mean, voluntary change is presumably much more enduring and sustainable, so that sort of fits with the concept in any case. But do you see a possibility, and from various different political aspects, of greater regulation forcing this to happen?
I think there is a role for government, but working with the investors. So governments are increasingly not very good at policy and regulation. They're captured by various special interests and so on. But if we had representatives of long-term people with a long-term stake in the economy itself, properly involved in the policy debate, I think that would lead to a better outcome. So one of the real defining experiences for me recently was being involved in the COP21 negotiations last year in Paris in December, but also the business and investment summits earlier in the year in Paris and then in New York. And what I learned there was that that companies and shareholders were kind of aligned. They were increasingly realizing that they wanted the same thing. I sat beside the chief executives of two major European oil companies who were both arguing for carbon prices to be introduced. And the environment ministers and policymakers didn't want to do this because they're very worried about introducing a new tax, because that, of course, brings electoral liability. It's very difficult as a politician to pursue additional taxes if you want to be re-elected. So there's something there around the power of that business investor dialogue, a vision for the future which is interconnected, people who are properly serving their organizations as affiliative relational leaders. And I'm seeing that sort of leadership now emerging. And for those people then to be in dialogue with policymakers to get the best policy outcome, seeing this as something where we're working together for that rather than competing for a finite set of resources, which of course is the traditional way of looking at these things.
I mean, do you see where's that shift going to come on the political side then? I mean that.
Yeah, I know we look at politics in despair sometimes. How can we do this? But there have been some shifts, and I think the COP21 agreement is actually a pretty good one, and now needs to be implemented. And so, although we might be disappointed with the day-to-day machinations of the political class, we do find amongst the policymakers themselves a desire to talk to shareholders, to large investors. And of course, we shouldn't forget that the city does fund quite a lot of the political process, not just in the UK, but financial services more broadly. Mm-hmm. And that connection, that funding connection, could be turned into a positive thing, I think. There's also quite a lot of negative lobbying that goes on, of course. And one of the things that we work on at Hermes is trying to persuade companies to stop lobbying to reduce the regulatory burden, whilst at the same time saying they want it to increase. That does happen from time to time. one of our engagements around that.
Getting the left and the right hand to work in unison.
Indeed. I mean, you can imagine all sorts of malice and ill intent in some of these behaviours, but I think a lot of it's just tradition.
Right.
I very rarely encounter people who are genuinely out to do the wrong thing and misbehave, but it's more just that they come to understand their jobs as being in a particular way. It's linked to corporate culture and culture within investing organizations. And many people that came into investment in the 80s and 90s came in to make money for themselves. That's what they expected to do, and the investment world was set up that way. And that needs to shift. And I think the millennials now coming into investment management want something else. And I think we can build on that.
I think that's a really interesting insight. I mean, you say that it's taken you 10 years to have got to where you are now, and I'm picking up a sense of frustration that you haven't moved things along further. But in fact, this is a super tanker that is not going to pivot quickly on its axis, is it? It's a huge industry, global industry with lots of vested interests that has a long history to it as well. And so, trying to change anything is inevitably going to be gradual.
But it is, and there are things we could do. I mean, I don't want to get sort of too technical about it, but looking at the way we value companies within investments. So the current valuation approach looks at the present value of future cash flows to the dividends of the company, and you discount them into the future. So you put a lower value on them the further out they are,
Yeah.
and that tends to lead to a short-term perspective on the companies themselves. And so that approach is what's used by most investment managers to analyze company shares, and it's currently the dominant valuation approach. The value of the firm is the assumed cash flows, and you adjust that or discount that into the future. But what if we valued companies differently? Say we valued them in a more dynamic way based on their relationships. So you could say that the change in the value of the firm would be linked to the change in the quality of the relationships the company had with its stakeholders, the employees and the suppliers and the customers and shareholders and so on. And that would lead then to a different way of seeing companies and a different way of interacting with them. And so the things like that I think we could do and offer to the city as a different approach, which might then sit quite well with a change in...
But are the metrics to go with that are quantifiable?
Yes. Well, I think so. I mean, there's quite a lot in economics and investment which looks quantifiable, but which actually is quite qualitative. The equations that appear in economics are often not really very mathematical. They add up all sorts of things and come up with something which looks firm and quantifiable, but probably isn't. Yeah. So. I'm sure we could produce a nice economic equation. Well, I've got one in front of me, actually, but relating to dynamic valuation by relationship aspects. I'm working on a model for this at the moment, which I'm due to present at a conference soon.
Okay. I mean, I'm aware of time. Just sort of focusing back on you as an individual, I mean, what particular skills have you become aware of that you use that are powerful in engendering this change that you've created?
Well, as I mentioned earlier, I have it's almost a compulsion, really, to bring people together and to resolve conflict and so on. I think that has motivated me to try to solve these issues and problems. The other is trust. I tend to engender trust in people, and I think that's something which has been very helpful to me in my career. So that combination of wanting to help to bring people together, resolve conflicts, and to do so in a way which engenders trust has led to the success I've had, I think, and has enabled me then to do things which perhaps are unusual within the investment world. So that to get people working more together, recognizing they're interconnected, was really the history of the development of engagement and the development of the engagement service within Hermes EOS. Knowing that sustainability implies profitability. People think about sustainability within investment and business as somehow altruism or tree hugging, giving up something in order to do good. But actually, a sustainable company is a profitable company. That's the point. It implies profitability, but it does mean that the generation of profits for shareholders are not confused with corporate purpose, that it's a consequence of good corporate purpose. And those are the sorts of insights that I'm bringing into investment from the business world and encouraging the business world itself. And so I think it's a desire to serve, perhaps, and to help the system itself. I've never really been concerned with making money for myself or advancing my own position.
No, that's fascinating. Brilliant. I mean, just sort of furthering that, and this is one of my sort of standard closing questions. Do you have any daily rituals that you enact to help you manage? I mean, you're obviously incredibly busy. Are there any things that you do on a regular basis that? So I've always looked after myself in terms of exercise. So I exercise most days. So swimming twice a week, weight training twice a week. And I've recently started yoga, which I find very helpful. I guess I'm getting older now. So with my 50th birthday looming on the 1st of August, I've decided that flexibility in yoga might be a helpful thing. And about 2 years ago, I started meditating as well, which has been helpful too, I think, just in dealing with the day-to-day pressures. I travel a huge amount. I'm away
out of London more than half the time. And in order to deal with a very busy schedule and lots of meetings, then I find meditation is very helpful.
That's fascinating. Thank you. And finally, what advice would you give your 25-year-old self now?
Don't be afraid, I think. A lot of us are conditioned in our lives by fear, and that can hold us back. And I think at various points, I've been concerned that if I raise something or presented the world or how it should be in a particular way, then that might be reviewed negatively by those I was working with. And I perhaps could have pushed a bit harder and faster if I'd known that. So yes, let go of the fear, and that way you can realise what's possible.
Superb, Colin. Thank you very much. I mean, I think it's
well, you're welcome.
An amazing area that you're engaged with, and hugely uplifting. Because often the stories we get out of the financial services world that are not that uplifting, and I think this, because it interacts with the wider world, is really exciting. So thank you very much for the conversation. I've really enjoyed it, and I'm sure our listeners have too.
Well, Roddy, thank you very much. It was a pleasure.
I hope you enjoyed my conversation with Colin Melvin. What Colin is looking to achieve is enormous in scope, and all the more impressive when you consider the vested interests and traditions, not to mention money, that need to be engaged with to achieve that change. The key takeaway I took from the conversation is the combination of passionate determination he has, understanding the power to create positive benefits for all by getting the investment industry to embrace this different approach, combined with a very calm but very determined chipping away at the problem. Essentially happy to enable the process, if not one brick at a time, then one international accord at a time, slowly reshaping the environment the sector operates in. Colin clearly sees having put the structure of his business in place and set up the United Nations Principles for Responsible Investment Accord as only the first steps. He acknowledges that it's taken 10 years, but the hard work still lies ahead of actually executing that change. A great lesson for all of us that sustainable change is hard work and can take a long time to really bed in. Colin's reflection that much of what he's achieved is down to his trust-engendering approach is a powerful point we should all think on. From my work at developing leaders, I see time and again how gaining and building trust is a fundamental part of leading any change. After we stopped recording, Colin mentioned that it occurred to him his final comments on advice to his younger self on not overly worrying about his career and progression were perhaps misplaced, as he cannot tell if it was that conscientious anxiety that drove him to success or not. A typically self-aware reflection from a very thoughtful guest. I hope you enjoyed listening to this conversation as much as I did. Having listened to Colin, you now have some more knowledge, but knowledge is not power. It is only potential power. The real ability to create change is through great execution, taking action towards achieving your goals. So I urge you to start applying some of these concepts straight away. Like many of our listeners, you can use the transcript of this show to remind yourself of many of Colin's points. So please go ahead and download the transcript on the website www.innovationecosystem.com/14. We're working hard to create an ebook aimed to give you an answer to the question, what does it really take to make innovation happen in your organisation? For now, we have synthesised the lesson from 5 of our guests into a short book that will help you and your organisation become more entrepreneurial and innovative. It's called Joining the Dots and is available to download on the Innovation Ecosystem homepage. Use it and the transcript to review the conversation, highlight sections of interest, scribble in the margins, and share it with your team and colleagues. And if you prefer pictures, you can look at the visuals we made for this episode and for the preceding 15 shows in this series. All are available on the website. Next week, Mark talks to Scott Pelton, the founder of an amazing company called Tignum, with whom Mark has worked in the past, and which focuses on helping executives optimize their performance. Scott talks about emerging technologies which will alter how we perform, as well as giving access to resources and tools that you can use straight away to boost your performance. If you enjoy these shows, we'd really appreciate it if you can take a couple of moments to rate and review them on iTunes. The shows take a good bit of time and energy, and we love to get your feedback that way. Many thanks to all our listeners who have left reviews. We really do appreciate them. Keep them coming. And do contact us if you have any questions for our guests or other comments. I look forward to being with you again shortly.